Have you ever heard someone say they make money in real estate, but they never swing a hammer, never talk to tenants, and don't even own a property in their name? Sounds shady, right? Well, not necessarily. There's a booming world of real estate, where investors pool their money together, let professionals handle the hard stuff, and still earn passive income. It's called real estate syndication, but is real estate syndication really worth it? Stick around, because by the end of this video, you'll know exactly what it is, how it works, and whether it belongs in your investment strategy or if you should run far away. Let's unravel the truth. Number 1. What even is real estate syndication? Imagine you and a group of friends want to buy an apartment building, but none of you have $1 million lying around. So, you each chip in what you can, and you hire someone who knows what they're doing to run the show. That's basically real estate syndication. It's a group investment in a big property, like an apartment complex, self-storage facility, or even a hotel, where one group of people brings the money and another group brings the expertise. The people investing money are called limited partners. They're passive. They don't do the work. The professionals managing the deal are called general partners or sponsors. They find the property, negotiate the deal, oversee renovations, manage the tenants. They do everything. It's like ordering a full meal instead of cooking it yourself. You pay, and someone else does the cooking. Number 2. Why do people join syndications? Let's be honest. Not everyone has the time or desire to manage tenants calling at 2 a.m. because of a leaky faucet. With syndication, you get exposure to real estate, often big, cash-flowing properties, without becoming a landlord. That means passive income, potential appreciation, and tax benefits, all without the stress of managing property. Plus, these deals often offer preferred returns, meaning investors get paid first before the sponsors take their cut. So, if a syndication promises a preferred return of 8%, you get your 8% before the sponsors make any profit. That's a win for passive investors. Number 3. What's the catch? Of course, it's not all sunshine and rental checks. One major downside: your money is locked up. Most syndication deals last anywhere from 3 to 10 years. Once you invest, you can't just pull your money out next month like you can with a stock or a savings account. And there are risks. If the property doesn't perform, you may not get your full return, or worse, you could lose your investment. Also, many deals are only open to accredited investors. That means you need to either earn at least $200,000 per year or have a net worth of at least $1 million, not including your primary home. If you don't meet that threshold, some deals will be out of reach. Number 4. How does a typical deal work? Let's break it down step by step. First, the sponsor identifies a promising property. Maybe it's a 200-unit apartment building that needs renovation. They do due diligence, inspections, appraisals, financial analysis. Then they put together a business plan, maybe renovate the units, increase rent, improve management, boost profits. Next, they create a legal structure, usually a limited liability company, and they raise money from investors like you. You might invest $25,000, $50,000, or more. Once the property is purchased, the sponsor handles the renovations and operations. As rents go up and the building becomes more profitable, investors receive quarterly or monthly distributions. Basically, your share of the profits. Then, at the end of the hold period, say 5 years, the property is sold. You get your original investment back, plus a portion of the profit from the sale. Let's say you invested $50,000. Over 5 years, you receive $20,000 in cash flow. Then, when the property sells, you get back your $50,000, plus another $30,000 in profit from the appreciation. Total return: $50,000 invested, $50,000 returned, plus $50,000 in gains. Not bad, but again, no guarantees. Number 5. Where do you find these deals? This is where things get interesting. Most syndication deals aren't listed on a website like Zillow or posted on Craigslist. They're typically shared through private networks, email lists, referrals, or real estate investment groups. That's why networking is key. You want to connect with reputable sponsors who have a track record of successful deals. Many experienced investors build relationships with a few trusted sponsors and invest in their deals over time. And always read the offering memorandum, which outlines the details, risks, fees, and expectations. This is not the time to skim and click I agree. Number 6. Can you really trust these sponsors? That's the million-dollar question. Here's the truth. Not all sponsors are created equal. Some have years of experience, dozens of successful exits, and loyal investor bases. Others might be overconfident newbies playing with your money. Before you invest, do your homework. Ask questions. How many deals have they done? What went wrong in past deals? What's their communication style? Do they send regular updates? Do they invest their own money into the deal? If a sponsor won't answer your questions, walk away. And remember, if something feels off, it probably is. Number 7. What kind of returns can you expect? This varies a lot, but let's talk ballpark. Most real estate syndications aim to offer total annual returns of 12 to 18%. That includes both cash flow and profits from the eventual sale. Some might offer a preferred return of 7 to 10% annually, meaning you get that much before they take their cut, but it depends on the deal type. A value-add apartment project might take time to stabilize, but offer higher returns later. A stabilized, fully leased property might offer more consistent cash flow, but lower upside. Just remember, if a sponsor promises 30% returns with zero risk, run. There is no such thing as guaranteed high return without risk. Number 8. What about the taxes? Here's one of the biggest perks, and it often surprises beginners. Real estate syndications often provide you with tax benefits. Thanks to depreciation, you might receive thousands of dollars in passive income and still show a paper loss. On your tax return, that means your cash flow might be tax deferred, or even tax-free in some years. You'll usually get a Schedule K, one during tax season. And while you should always check with a tax professional, many investors use these benefits to offset other passive income. It's like getting paid and keeping more of it. Number 9. Who should avoid syndications? Syndication is not for everyone. If you need quick access to your cash, if you're not comfortable trusting someone else with your investment, or if you're still building your emergency fund, you may want to wait. It's also not ideal if you want total control over your real estate investments. In syndication, you're a passenger, not the driver. You can't just decide to sell the property early or pick which color to paint the walls. That's the trade-off. For being hands-off, number 10, is it actually worth it? All right, the big question, is real estate syndication worth it? Here's the honest answer. It depends on you. If you have extra capital to invest, if you want real estate exposure without the hassle, if you're okay with locking your money away for years in exchange for passive income and possible big returns, then yes, it could absolutely be worth it. But only if you do your homework, only if you vet the sponsor, and only if the deal fits your goals. Remember, syndication is a tool, and like any tool, it's powerful when used the right way. Number 11. What are the upfront costs and fees? Many beginners are surprised to learn that real estate syndications come with fees. These fees compensate the sponsors for the work they do. Typical fees include an acquisition fee, which is often around 1 to 3% of the property purchase price. There may also be asset management fees, which cover ongoing operations, usually around 1 to 2% of gross revenue. Some deals include a disposition fee when the property is sold or refinancing fees during the hold period. You may also see a promote or carried interest. This is the sponsor's share of profits after investors receive their preferred return. Always read the fine print and ask for a breakdown of fees, because even a great investment can underperform if the fees eat too much of the profit. Number 12. Are there different types of syndication deals? Yes, absolutely. Not all syndications follow the same strategy. Some focus on value add, buying underperforming properties, fixing them up, raising rents, then selling for a profit. These usually carry more risk but offer higher potential returns. Others focus on stabilized assets, properties that are already performing well, providing steady, predictable cash flow with lower risk. Then there are opportunistic deals, like ground-up developments or heavy rehabs, which have the highest risk but also the highest potential upside. Make sure you understand the strategy before jumping in, because a cash flow-focused investor may not be happy waiting 5 years for a payday that never comes. Number 13. What happens if the market crashes? This is one of the biggest fears new investors have. Real estate is a long-term game, but it's not immune to market cycles. If the market dips, rental income may decline, property values may drop, renovations may stall. A good sponsor will have contingency plans, like reserve funds and conservative projections to weather storms. Ask sponsors what their plan is if things go south. Will they hold longer? Cut costs, delay distributions? You want someone who's not just good in boom times, but who's battle-tested when things get rough. Number 14. How much control do you really have? This might sting, but in most syndications, you don't have much control at all. You don't get to vote on paint colors. You don't decide when to sell the property. You're a limited partner. Emphasis on limited. Your role is to fund the deal and receive your share of the profits. If you're someone who likes to be in the driver's seat, this model might feel frustrating. But for others, that lack of involvement is exactly what they want. It's freedom from decision fatigue. Just make sure you're the kind of investor who's okay sitting back and letting others steer the ship. Number 15. Can you reinvest your earnings? Many syndications pay out quarterly or monthly distributions. You can use this cash however you want. Spend it, save it, or reinvest it elsewhere. Some sponsors offer a reinvestment option, letting you roll your earnings into future deals. This can accelerate your growth through compounding. Let's say you invest $50,000 and receive $4,000 a year in distributions. If you reinvest that into new deals each year, your real estate portfolio can snowball faster than just letting the cash sit in your bank account. It's not automatic, but with planning, reinvestment can make a huge difference. Number 16. How do you know if a deal is legit? This is a critical question because not all syndications are created equal. Look at the offering documents, verify the property address, and look it up online. Check the sponsor's past deals. Are they public? Have they exited profitably? Request references from past investors. Be cautious if returns sound too good to be true. Watch out for pressure tactics like, "You must wire funds today," or "Spots are filling up in the next hour." Legitimate deals will give you time to review and think. And always use a separate bank account for wiring money, with verification steps to avoid scams. Due diligence isn't optional. It's protection. Number 17. How long does it take to see returns? That depends on the deal structure. Some syndications offer immediate monthly or quarterly distributions. Others may wait 6 months to a year before cash flow begins, especially if renovations or repositioning is required. Ask for a timeline before you invest. Look for projected distribution dates and compare them to when your bills are due. Real estate is not a get-rich-quick game, but if you're patient, it can be a get-rich-slowly and sustainably kind of game. Number 18. What documents should you expect to receive? After agreeing to invest, you'll be asked to sign a private placement memorandum, PPM. This outlines the risks, structure, and legal terms of the deal. You may also receive a subscription agreement and an operating agreement. Together, these documents define your rights as an investor, how profits are split, and how decisions are made. You'll also get ongoing investor updates, usually monthly or quarterly, with financials, progress reports, and rent collection updates. At tax time, expect to receive a Schedule K. 1. This document reports your share of income, losses, and deductions. It's important to keep these records organized, especially if you invest in multiple deals. Number 19. Can you invest through a self-directed IRA? Yes, and it's a powerful strategy. If you have a self-directed IRA or solo 401k, you can invest in syndications using retirement funds. That means you could earn real estate income inside your IRA, deferring taxes until retirement, or even avoiding them altogether with a Roth account. But there are rules. You can't personally benefit from the property, no staying in it, or managing it, and your IRA must be properly structured to hold alternative assets. Work with a custodian who specializes in self-directed accounts to stay compliant. It's a great way to diversify retirement funds beyond stocks and bonds. Number 20. How do you build a long-term strategy with syndications? Many experienced investors don't just invest in one deal and walk away. They build a portfolio across different sponsors, markets, and asset types. They ladder investments, so they mature at different times. That way, they have cash flow coming in every year. While new deals are still growing in the background, some investors set a goal. Invest $50,000 into a new deal each year for 5 years. By year 6, They've got cash flow from 5 properties and possibly a big lump sum when the first deal sells. It's not flashy, it's not viral, but it's how many people quietly build wealth while living their lives. You don't need to be a millionaire to invest like one, but you do need to be informed. So, would you ever invest in a real estate syndication? Let me know in the comments. I'd love to hear your thoughts.